What's up, people? Welcome back to Invest with T-Claus. My name is Tevi, and this channel is dedicated to my investment journey, along with coverage on crypto, Tesla, Neo, Virgin Galactic, and ChargePoint. Come for the information and stay for the perspective. So happy Easter Sunday to all of you who celebrated or simply partake in the festivities. We just wrapped up a shorter trading week, marked, of course, by hot inflation data. How hot? It rose 8.5% on a year-over-year basis, and basically the last time we saw these numbers, I wasn't even alive. So there's that. Now, despite the hot print, the market didn't sell off significantly, right? Instead, things were fairly low-key, and a discussion which up until recently was all about doom and gloom is now being framed a bit more positively. Kind of makes you wonder why that would be, all right? Well, today's video will be more focused on the macro environment and where we are in this cycle. I'll go over a few key commentaries I came across this week and share a couple of the clips from Tom Lee at Fundstrat on where he thinks we are in the cycle. I'll of course add my own thoughts along the way. As always, this is not to be taken as financial advice. I'm not a financial advisor. This is my personal approach to investing and the thought process behind it. That said, I do recommend watching all the way through so that you don't miss out on any pertinent information I'll be sharing. Drop this video an early like if you haven't already, and hit that subscribe button. Those are two easy ways to show your support to the channel and help it grow if you appreciate the content. All right, let's get into it. Okay, so let's think about what happened this week. We saw earnings from 4 major banks. Some beat expectations, others came in line with expectation, and the rest were a bit mixed. That said, after a stellar 2021 and Fed interest rate increase going into effect with the war in Ukraine breaking out, it was widely expected that we would be kind of all over the map, right? So markets really didn't react excessively in any direction when a number dropped. The talk around recession that was all over the news during most of March and early April can now be summed up by this statement here, and I quote, "Economists generally don't expect a recession this time around, though many on Wall Street are raising the probability of a downturn," end of quote. Recession probability made for a great narrative to help support profit taking while Wall Street was repositioning, but again, in the grand scheme of things, a recession in 2022 was unlikely, as I said before, and we're now getting confirmation of that. Regarding the CPI number itself and what it means, here's a bit more insight, and I quote, "Overall, this report is encouraging at the margin, though it is far too soon to be sure that the next few core prints will be as low. Much depends on the path of used vehicle prices, which is very hard to forecast with confidence." And they add, "We're sure they will fall, but the speed of the decline is what matters," end of quote. Now, the biggest culprit for these high inflation print numbers has been and continues to be used vehicles and truck prices, right? This is a very simplistic way and generalized breakdown, but if you think about it, a ton of money was injected into the economy due to the pandemic. People found themselves with a ton more cash than they were used to. That drove extremely high demand at a time where the supply chain had been brought to a crawling speed. We've since been playing catch up, and we're now at a point where the pendulum is swinging back towards center, where there is equilibrium between supply and demand, which is why we're starting to turn the corner. So the bottom line is this: inflation to date has been largely driven by supply chain issues. The data now pretty much conclusively supports it. And as those pressure ease, the Fed hawkish stance or hardcore approach to raising rates will also subside. Does every economist, market strategist, and institutional investors realize this? Well, of course they do. If I can figure it out, so can they, right? This then goes back to my point earlier this year that everything in the bond and equity market revolves around narratives. We have a lot more clarity now, and tax season is just about wrapping up. So this is a good segue into some commentaries from Tom Lee, who is a financial advisor, and where he thinks we are in this cycle. Take a listen.
Everybody's trying to come up with the next and greatest acronym. You have B.E.E.F, B-E.E.F, Bitcoin plus Bitcoin equities, energy, and the FANGs.
Yes.
That's your best strategy right now for investors watching?
Yes, yes, that is.
Tell me why.
Well, FANG, we think, I'll start with the bottom. FANG, I think in the next 6 months, they got obliterated, been in a bear market now for more than a year, reasonably priced, GDP grower, inflation protected. Energy we've liked for a long time. It's still our top sector pick. And then we like Bitcoin and Bitcoin equities because if the environment shifts to risk on, crypto follows. And, we have to keep in mind, April 18th is tax day, and crypto has about $500 billion of capital gains taxes. So on a T+2 basis, people have to be selling their crypto and their stocks by today in order to pay their taxes by Monday.
But don't you need, a really risk-on market to go Bitcoin right now, don't you? I mean, it's so highly correlated to it.
Yeah, or you could get regulatory clarity, and there are chances for that because, as you know, the Federal Reserve's trying to get some feedback on their white paper on central bank digital coin. We might get some clarity on our Bitcoin ETF. We know corporations are using Bitcoin, so I think the usefulness of Bitcoin is rising. And if you have more users and more reasons to use it, that's why Bitcoin could go up.
It's probably pretty obvious that I agree with a lot of the points he just made this week. It aligns with the drum I've been beating since January on where we are heading, right? Consider that since November last year, we've been trending down, the market has sold off and eventually bottomed. At this point, it's fair to say that every market participant with a mid to long-term view has sold off enough to reposition themselves and cover the tax bill. So what comes next? Well, let's hear what Tom has to say.
So risk goes back on. People put money into crypto like Bitcoin, and then we go back to the Qs, and we just go right back to the growth trade?
That's right. That's what I think is sort of what makes the second half strong. And of course, NASDAQ is a huge component of the S&P, and that's what keeps us from hitting the February 24th lows.
What if inflation hasn't peaked? What if everybody's getting a little too giddy?
I think we have episodic inflation. So I think it's correct. We're still going to see worse wage inflation and shelter inflation. But what people have to keep in mind is that goods inflation was a huge contributor last year. Used cars alone was 1.5%. New cars was 0.4%. So that's 2 percentage points of the 4% was just cars. And that's now potentially going to be a negative CPI effect in the second half of this year.
At the risk of sounding like a broken record, all the signs are pointing to not just crypto, but the stock market news cycle shifting, right? We're now entering cautiously optimistic territory. This coming week, tax season ends. The remaining large banks will report earnings, giving full clarity on how much disruption resulted from the geopolitical conflict. This will also allow for better forecasting and risk management moving forward for institutional investors, right? Because at the end of the day, they're the ones who move markets, not you and I. They do. Big cap tech, so think Apple, Amazon, Meta, Google, Microsoft, all report in the last week of April. If they all report in line with the expectations or beat, that will provide a big boost of confidence for that growth trade Tom was just talking about. And that should see us move meaningfully higher as we get into May. It'll still be choppy, but we'll likely leave the current trading range that we've been in behind for the next one up, where we'll likely be until the end of Q2. So to bring it back to the specific stocks this channel covers, COVID lockdowns in China are easing with both NIO and Tesla resuming production. We'll hear from Tesla this coming week during their earnings call on how well they navigated supply chain issues, COVID, and inflation. Spoiler alert, they probably did awesome anyways. NIO reports on the 28th of April, if I remember correctly, and Virgin Galactic is the first week of May. With the improving macro backdrop, assuming individual performance is on par with expectations, their stock prices will continue to rise. ChargePoint, of course, benefits directly from NIO and Tesla pumping more EVs out to consumers. So all in all, I'm feeling pretty bullish about where we're heading directionally. So what is my strategy? Well, ultimately, my plan, as always, is quite simple. The window of opportunity for the best deals, I think, is closing. I have a bit more buying to do in both stocks and crypto, with, again, crypto being the priority here over the next 2 to 4 weeks. After that, I'll simply sit back and ride the wave as it builds into a massive tsunami. I'll be looking for signs then that we are nearing the top, at which point I'll likely trim some or all of the extra shares I added. As we approach that point, I'll of course share with you all why I think that is the case. But on that note, that is it for today. Time for me to get out and enjoy some of the festivities. We'll talk Tesla next week. Don't forget to drop this video a like if it helped you gain some new insight, and share with others who you think could also benefit from it. For my newcomers, subscribe and don't forget to ring the notification bell so that you too can stay in the know. I'll be back on Sunday. Till then, thank you for watching. Stay humble, hustle hard, and I'll see you in the next one.